If you've got $10,000 sitting in your bank account right now and you do nothing, next year it'll buy you what $9,000 could buy today. Inflation is quietly stealing your money. And the worst part? Most people don't even notice it's happening. In this video, I'm breaking down exactly how inflation eats away your savings, why traditional saving doesn't work anymore, and 5 practical ways to protect your money, even if you're just getting started. 1. What inflation really does and why it's worse than you think. Inflation isn't just a number you hear on CNBC. It's the invisible tax that hits you every single day, at the grocery store, at the gas pump, in your rent, in your healthcare bill. The U.S. inflation rate averaged around 3.4% in 2024, down from the record highs of 9% in 2022. But even just 3% inflation means your money loses about 1/3 of its value over 10 years. That's right, $100,000 sitting in cash today will only have the buying power of roughly $72,000 in 2035 if inflation stays around 3%. And if it creeps back up, you're losing even faster. Inflation isn't just numbers. It's the silent erosion of your future purchasing power. 2. Why traditional saving doesn't work anymore. Our parents could park their money in a savings account and earn 5 to 6% interest without taking any risk. Today, even with higher rates in 2025, most savings accounts still pay under 2% after fees and taxes. Let's do a quick reality check. If your high-yield savings account pays you 4% and inflation runs at 3.5%, your real return is only 0.5%. If inflation spikes back to 6%, you're actually losing money every single day. Your cash just sits there. So, the safe choice isn't really safe anymore. Your balance might not go down, but its value definitely does. The question isn't how do I save my money, it's how do I protect my money's buying power? 3. Step 1. Understand your cash flow. You can't outsmart inflation if you don't know where your money's going. Most Americans underestimate their monthly expenses by 20 to 30%. Inflation magnifies that blind spot. Everything from groceries to car insurance quietly costs more each year. Start by tracking. Fixed expenses, rent, utilities, insurance, variable expenses, food, subscriptions, lifestyle, and how much you actually have left to invest each month. If you don't control your spending, inflation will control it for you. 4. Step 2. Diversify your money. Stop parking it all in cash. Keeping all your savings in one place, even a high-yield account, is like leaving an ice cube in the sun. It looks solid for a while, but it melts before you know it. A solid personal portfolio spreads your money across 4 categories. Cash, liquidity, for emergencies, 3 to 6 months of expenses. Investments, to grow faster than inflation. Real assets that hold intrinsic value, like real estate or commodities. Self-investment, skills, education, health, the best inflation hedge of all. Let's break those down. 5. The 5 smart strategies to protect yourself from inflation. 1. Invest in broad index funds and ETFs. If you look at history, the S&P 500 has returned about 10% per year on average over the past 50 years, even after multiple recessions and inflation spikes. That's more than enough to outpace inflation in the long run. Low-cost ETFs like VTI, VOO, or SCHD let you own hundreds of companies for almost no management fee. And if you automate it, investing a set amount every month, you benefit from dollar-cost averaging, which smooths out the market's ups and downs. Remember, you don't need to time the market. You need time in the market. 2. Own real assets. Inflation loves to destroy paper money, but it struggles against tangible assets. Historically, real estate has been one of the most effective inflation hedges. Property values and rents tend to rise along with prices, which means your real estate investment often keeps pace with, or beats, inflation. If buying property isn't realistic right now, you can still get exposure through REITs, real estate investment trusts, or real estate ETFs. Other real assets that historically preserve value include gold, silver, and commodities. You don't have to go all in. Even 5 to 10% of your portfolio can help balance inflation risk. 3. Invest in yourself. This might sound cliché, but it's the best inflation hedge there is. When prices go up, your income needs to go up even faster, and the only way that happens is if your skills are in demand. Learn something that boosts your earning potential: coding, design, marketing, finance, sales. Take online courses, start a side hustle, or get a certification that increases your hourly rate. If you can grow your income by 10 to 15% a year, you've already beaten inflation, no matter what the markets do. Step 4. Build a portfolio that works with inflation, not against it. Here's the truth. Inflation doesn't have to be your enemy. If you understand how it works, you can actually use it to your advantage. Think about it. Inflation means prices are rising, right? Well, if you own assets whose value rises with those prices, you're on the winning side. That's the entire logic behind building an inflation-resistant portfolio. Now, let's dig into what that actually means for you. 1. Own productive assets. There are two kinds of assets: consumable and productive. Consumables lose value over time, like cars, gadgets, or fashion. Productive assets earn for you, like stocks, businesses, or rental properties. When inflation hits, productive assets adjust automatically. Companies raise their prices to keep up with costs, which boosts their revenues, and that eventually pushes stock prices higher. That's why long-term investors in the stock market tend to outpace inflation over decades. If you own equity in good businesses, even indirectly through an index fund, you're not just preserving wealth, you're growing it faster than inflation can eat it. 2. Hedge with real estate and tangible assets. Real estate isn't just about flipping houses or renting Airbnbs. It's about owning something real, something people always need. When inflation rises, rent typically goes up too. Property values follow. That means your mortgage payment stays the same while your property's value increases. Inflation actually works for you, not against you. If buying property outright feels out of reach, you can start with fractional investing apps, or REITs. They let you get exposure to real estate growth without managing tenants or taking out big loans. Even small allocations, 10 to 20% of your portfolio, can stabilize your returns and protect against price shocks. 3. Hold a little bit of crisis insurance. I'm talking about assets like gold, silver, or Treasury inflation-protected securities, TIPS. These aren't growth machines, they're stability tools. Gold and silver historically hold their value during currency devaluation. TIPS literally adjust their principal with inflation. The government pays you interest on a value that rises with CPI. You don't need to go overboard here. Even 5% in these assets can cushion your portfolio when inflation spikes unexpectedly. 4. Don't forget bonds. But choose wisely. Bonds used to be the classic safe investment until inflation started biting their returns. But not all bonds are equal. Short-term Treasury bills, floating rate notes, or inflation-linked bonds can still play a defensive role. They're not exciting, but they're predictable, which is valuable when the economy gets shaky. Avoid locking your money in long-term fixed-rate bonds when inflation is uncertain. That's like signing a deal to lose purchasing power for the next decade. 5. Keep cash, but give it a job. Here's the paradox. While cash loses value during inflation, you still need it. The trick is to keep enough, but not too much. Think of cash as your safety net, not your strategy. It's what gives you flexibility to invest when opportunities arise, or to cover unexpected expenses without selling assets. 3 to 6 months of expenses in a high-yield savings account or money market fund is perfect. Beyond that, your cash should be working somewhere. Step 5. Win the psychological game. Beating inflation isn't just about numbers. It's about mindset. Inflation scares people. It triggers fear, scarcity, and short-term decisions. That's when people panic, stop investing, or dump cash into whatever's trending. Here's what smart investors do instead. They stay consistent, investing through every market cycle. They avoid emotional reactions to headlines. They focus on long-term purchasing power, not daily price swings. Inflation rewards patience and discipline. If you keep adding to your investments, even small amounts, you'll come out ahead of 95% of people who are still waiting for the perfect time. Remember, the market doesn't reward perfection, it rewards persistence. Step 6. Turn inflation into opportunity. Here's something most people never realize. Inflation creates winners and losers. Losers hold cash. Winners hold assets. But there's a third group, builders. These are people who use inflationary periods to grow their businesses, improve their skills, or launch new income streams. When prices go up, demand shifts. Entire industries open up, from energy efficiency and repair services to online education and freelancing. If you're adaptable, inflation isn't just survivable, it's profitable. Use inflation as motivation to upgrade your income, automate your finances, and build something that earns even while prices climb.